For most of modern financial history, saving money was treated as a moral virtue and an economic guarantee. You worked, you earned, you saved, and time did the rest. Your money did not have to be clever. It just had to sit still. Interest compounded quietly, prices moved slowly, and patience was rewarded. That mental model is now obsolete, not because people became irresponsible, but because the mathematics underneath saving changed. To understand why saving money became a losing strategy, you have to separate two concepts most people still confuse: nominal interest rates and real interest rates. Nominal interest is the number your bank advertises: 1%, 2%, 4% if you are lucky. Real interest is what actually matters. It is the nominal rate minus inflation. If your savings account pays 2% and inflation is running at 6%, your real return is negative 4%. Your balance goes up. Your purchasing power goes down. You feel richer. You are poorer. This distinction used to matter only in economics textbooks. Today, it defines everyday life. For most of the post-World War II era, real interest rates in developed economies were positive. Not spectacular, but positive. In the United States from the 1950s through the early 2000s, inflation averaged roughly 3%, while savings accounts and government bonds often paid more than that. A conservative saver could preserve purchasing power without taking risk. The system rewarded restraint. That changed in stages. The first warning came in the 1970s. Inflation surged into double digits after the collapse of the Bretton Woods system and oil shocks. Real interest rates turned sharply negative. Savers were punished. But that period was treated as an anomaly, a temporary crisis solved by aggressive monetary tightening in the early 1980s. When Paul Volcker pushed interest rates above 15%, inflation collapsed, and real yields became positive again. The lesson policymakers took was simple: inflation could always be crushed if necessary. They were wrong. The second and more permanent break came after the 2008 financial crisis. To prevent a systemic collapse, central banks cut interest rates to zero and kept them there. This was not a short-term emergency measure. In the United States, the federal funds rate stayed near zero from 2009 to 2015. In Europe and Japan, rates went even lower, in some cases negative. At the same time, central banks launched quantitative easing, expanding their balance sheets by trillions of dollars. From that point forward, savings stopped working in real terms. Bank deposits paid close to nothing. Inflation, even when officially low, was still positive. A saver earning 0.5% in a world with 2% inflation lost 1.5% of purchasing power every year. Quietly, predictably. Then came 2020. Between March 2020 and the end of 2022, the U.S. Federal Reserve expanded its balance sheet from roughly $4 trillion to nearly $9 trillion. More than $4.5 trillion was created in under 3 years. Inflation followed. By mid-2022, U.S. consumer price inflation peaked above 9%, the highest level in 4 decades. During that same period, the average U.S. savings account paid well under 1%. Even after central banks began hiking rates aggressively, most retail deposit rates lagged far behind inflation. The result was not subtle. Anyone holding cash experienced one of the fastest losses of purchasing power in modern history. $1 saved in 2020 bought dramatically less by 2023. Housing prices rose over 40% in many markets. Food prices surged. Energy costs spiked. Education and healthcare costs continued their long-term climb. Saving did not protect people from this shock. It amplified it. This is the core reality most people still resist. Negative real interest rates are not a bug. They are a feature. From the perspective of the system, positive real rates are dangerous. Modern economies are built on debt. Governments carry debt loads exceeding 100% of GDP. Corporations depend on continuous refinancing. Households are leveraged through mortgages, student loans, auto loans, and credit cards. If real interest rates stayed meaningfully positive for long periods, debt burdens would become unmanageable. Defaults would cascade. Asset prices would fall. Political stability would be threatened. Negative real rates solve this problem quietly. Inflation erodes the real value of existing debt. Governments repay yesterday's obligations with cheaper money. Borrowers benefit. Lenders and savers absorb the loss. There is no vote, no announcement, just math. Historically, this technique has been used repeatedly. After World War II, the United States held real interest rates below inflation for much of the late 1940s and 1950s. Government debt from wartime spending was inflated away over time. Savers paid the bill. The difference today is scale and permanence. What was once a temporary policy has become a structural necessity. Look at the numbers. As of the mid-2020s, total U.S. federal debt exceeds $34 trillion. Servicing that debt at genuinely positive real interest rates would consume an unsustainable share of government revenue. Even a few percentage points difference translates into hundreds of billions of dollars annually. The same logic applies globally. According to the Institute of International Finance, total global debt now exceeds $300 trillion, more than 3 times global GDP. In that world, savers are not just ignored. They are incompatible with system stability. This is why the old advice still sounds comforting, but no longer works. Put money in a savings account. Be patient. Avoid risk. These rules were designed for a different monetary regime. In a negative real rate environment, patience is punished. Safety is an illusion. Stability becomes decay. And the cruelty of the system is how invisible this decay is. Your bank balance does not shrink. It grows. Statements arrive on time. Numbers go up. But the unit of measurement is melting. What disappears is not dollars, but what dollars can buy. This makes the loss harder to feel, easier to deny, and politically safer to impose. By the time people notice, they usually misidentify the cause. They blame corporations, greed, supply chains, speculators. Rarely do they blame the structure that made saving mathematically impossible in the first place. This is the death of real interest rates. Not a temporary condition, not a policy mistake, but a foundational shift in how modern economies function. Saving money no longer means preserving wealth. It means accepting a guaranteed, slow loss in exchange for the illusion of safety. And once you understand that, the next question becomes unavoidable. If cash is designed to lose value, why do people stay trapped in it anyway? If negative real interest rates were the only problem, the solution would seem obvious. People would simply move their money elsewhere, out of cash, into assets that at least have a chance of keeping up with inflation. But that is not what happens. Instead, trillions of dollars remain parked in bank accounts, money market funds, and short-term deposits, even when everyone knows those balances are losing value. This contradiction is not irrational. It is a result of a structure that quietly turns cash into a trap. The cash trap begins with fear, but it is maintained by design. Cash feels safe because it does not move. Its number does not fluctuate daily on a screen. It does not crash 30% in a month. There are no headlines screaming about its volatility. In a world of unstable markets, that psychological stability is powerful. Humans are loss-averse. Behavioral economists have shown that people feel the pain of losses roughly twice as strongly as the pleasure of equivalent gains. A visible 20% drop in an investment account feels catastrophic. An invisible 20% loss of purchasing power over 3 years feels abstract, tolerable, and easy to ignore. The system exploits this bias perfectly. Holding cash guarantees a loss, but it does so slowly and quietly. Investing introduces uncertainty and volatility, even if the long-term math is better. When forced to choose between a guaranteed but invisible loss and a possible but visible loss, most people choose the former, not because it is rational, but because it feels safer. This is where the trap closes. After years of monetary intervention, asset prices no longer behave normally. Low interest rates do not just punish savers, they inflate the price of everything else. Stocks, real estate, bonds, private equity, collectibles, anything that produces cash flow or can be leveraged gets bid up. As a result, people sitting in cash feel permanently late. Houses are too expensive. Stocks feel disconnected from reality. Bonds yield less than inflation. Every alternative looks risky, overpriced, or both. So they wait. This waiting is not passive. It is expensive. While people wait for prices to come back to normal, inflation continues to erode their cash. By the time corrections arrive, their purchasing power is weaker than when they started. What felt like patience turns into paralysis. The years after 2020 offer a clear example. Millions of people held large cash balances, either from stimulus payments, pandemic savings, or fear-driven caution. Many want to buy homes, but felt priced out as mortgage rates fell and prices exploded. Others avoided equities because markets rebounded too fast and too aggressively after the March 2020 crash. By the end of 2021, U.S. home prices were up more than 40% from pre-pandemic levels in many regions. The S&P 500 had more than doubled from its lows. Cash holders missed both. Inflation then surged, ensuring they could not catch up later. This is a defining feature of the cash trap. It removes good options without removing responsibility. You are free to choose, but every choice is bad. The structure reinforces itself through income pressure. Wages rarely keep pace with inflation in real time. Even when they eventually adjust, the lag matters. Higher prices arrive first. Raises arrive later, if at all. This squeezes household budgets and reduces the ability to take risk. Cash becomes not a strategy, but a necessity for survival. Emergency funds grow, not because people want to save more, but because they're afraid of what happens if they do not. At the same time, debt becomes unavoidable. When asset prices rise faster than incomes, leverage fills the gap. Mortgages stretch to 30 years. Student loans follow people for decades. Auto loans lengthen. Credit cards bridge the difference between income and expenses. Cash balances are kept not to build wealth, but to manage instability. The more unstable life feels, the more cash people cling to, even as that cash decays. Central banks and policymakers often describe this behavior as excess savings, implying households are irrationally cautious. In reality, it is a rational response to a distorted environment. Volatility has been shifted out of cash and into everything else. Stability has become illusionary, but illusionary stability is still comforting. The trap deepens because exits are socially punished. When people finally move out of cash and into risk, they often do so late, near market peaks, after years of hesitation. When the inevitable corrections arrive, they confirm the original fear: I should have stayed in cash. The lesson learned is not that timing was wrong, but that risk itself is dangerous. So people retreat back into cash, poorer than before, more convinced than ever that safety equals money in the bank. This cycle repeats. What makes the cash trap especially effective is that it does not require coercion. No one is forced to hold cash. There are no capital controls for most people, no explicit bans. The system simply engineers a landscape where the alternatives feel unacceptable. You're allowed to leave, but every exit looks like a cliff. And while individuals struggle with these choices, institutions do not. Banks, corporations, and governments are not trapped in cash. They borrow at rates below inflation. They refinance endlessly. They convert cheap money into assets. The negative real rate environment that crushes household savers is a gift to balance sheets large enough to exploit it. So cash becomes a one-way mirror. From the outside, it looks like prudence. From the inside, it is erosion. By the time people recognize the trap, the damage has already been done. Their savings did not disappear in a crash. They were dissolved gradually, year after year, in exchange for peace of mind. That trade-off feels voluntary. It is not, because the final cruelty of the cash trap is this: the longer you stay, the harder it becomes to leave. At this point, the pattern should be clear. Saving fails not because individuals misunderstand money, but because the system itself has no use for widespread, long-term saving. In fact, from the system's perspective, savers are a problem. They slow the machine down. And modern economies are designed above all else to keep the machine moving. To see why, you have to start with debt. Debt is not a side effect of modern economic growth. It is the foundation. Governments borrow to fund spending without raising taxes. Corporations borrow to boost returns and survive competition. Households borrow to access housing, education, healthcare, and consumption long before they can afford them outright. This structure only works if debt remains serviceable. And debt remains serviceable only if money keeps losing value over time. Inflation is the lubricant. When inflation runs above interest rates, the real value of outstanding debt shrinks. What was borrowed yesterday is repaid with cheaper currency tomorrow. This is not theory. It is arithmetic. A government with 100% debt to GDP can survive decades of negative real rates. The same government would face immediate fiscal crisis if forced to refinance at meaningfully positive real yields. Taxes would have to rise sharply. Spending would have to be cut. Voters would revolt. So policymakers choose the path of least resistance. They suppress real rates. This immediately creates a conflict of interest. A saver wants money to hold value. The system wants money to move, to circulate, to depreciate. One of these goals must lose. Historically, it is always the saver. The punishment of saving is therefore not ideological. It is structural. A society that depends on leverage cannot afford a population that withholds spending and demands positive real returns on cash. Saving removes fuel from consumption. It reduces velocity. It exposes insolvency. In a debt-based economy, widespread saving is deflationary, and deflation is the one outcome central banks fear above all others. Deflation increases the real value of debt. Prices fall, but debt stays fixed. Defaults rise. Banks fail. Unemployment spikes. Political extremism follows. This is not hypothetical. The Great Depression remains a defining trauma in the institutional memory of central banking. Every major intervention since 2008 has been justified by the same argument: prevent deflation at all costs. That phrase is doing more work than it appears. Preventing deflation does not simply mean stabilizing prices. It means ensuring that holders of cash do not gain power by waiting. It means making sure money decays if it is not used. Inflation, low rates, and asset price support are the tools. Together, they form a system that rewards participation and punishes abstention. This is why saving is framed as virtuous, but treated as disposable. Public messaging still encourages financial responsibility, emergency funds, and retirement planning, but the underlying mechanics make traditional saving ineffective. You are told to save, but the rules ensure that saving alone will not protect you. The contradiction is intentional. It keeps people disciplined without making them independent. Look at who benefits. Governments benefit because inflation reduces the real burden of deficits. $1 trillion of debt is less threatening when each dollar is worth less every year. Corporations benefit because cheap capital allows them to roll over debt, buy back shares, acquire competitors, and survive mistakes that would have been fatal in a high-rate environment. Banks benefit from maturity, transformation, and asset inflation, even when depositors earn nothing. Who loses is just as consistent. Wage earners with limited bargaining power lose because incomes adjust slowly. Retirees lose because fixed income savings fail to keep up. Conservative households lose because prudence is penalized. Anyone who stores value in cash without access to leverage or assets absorbs the cost of keeping the system stable. This is why the system does not want you to save. Not because saving is immoral or outdated, but because it conflicts with the incentives holding everything together. A saver demands stability. The system demands erosion. The political genius of this arrangement is that it does not feel like theft. There is no explicit confiscation, no emergency decree, no dramatic collapse. Instead, Purchasing power leaks away through price increases blamed on vague forces, supply chains, geopolitics, corporate greed, pandemics, climate, demographics. Each explanation contains a grain of truth. None addresses the core mechanism. Even when interest rates rise, the structure remains intact. Nominal rates may increase, but they rarely stay above inflation long enough to reward savers meaningfully. Deposit rates lag. Real yields remain compressed. And the moment debt servicing costs begin to strain the system, pressure mounts to reverse course. Rate hikes pause. Inflation is tolerated. Savers wait for relief that never fully arrives. This is not conspiracy. It is constraint. A heavily indebted system has limited choices. It can default outright, inflate, or grow fast enough to outpace debt. Sustained real growth is the hardest option. Inflation is the easiest. And inflation requires negative real returns on safe money. That makes savers the shock absorbers of the economy. Understanding this reframes the question entirely. The issue is not whether saving is wise or foolish. The issue is that saving has been repurposed. It is no longer a path to security. It is a tool the system uses to transfer stability costs downward. Once you see that, the frustration many people feel starts to make sense. They did what they were told. They avoided excess. They planned ahead, and yet they fell behind. Not because they failed, but because the rules changed while the advice stayed the same. Which leads to the final distinction that matters. If saving money no longer preserves wealth, what does? By now, the mistake should be obvious. The problem was never that people saved too little. The problem was that they misunderstood what saving actually does in the modern system. Saving money and preserving wealth are no longer the same thing. Treating them as interchangeable is a final illusion that keeps people losing quietly. Saving, in its traditional sense, means holding currency or near-currency instruments with minimal risk. Cash, bank deposits, short-term government paper. Its purpose is stability and liquidity. It was never designed to fight inflation. It was designed for a world where inflation was low, predictable, and politically constrained. That world no longer exists. Preserving wealth is a different objective entirely. It means maintaining purchasing power over time. Not balances, not nominal values. Real capacity to claim goods, services, energy, labor, and security in the future. Once inflation becomes structural and real interest rates remain suppressed, these two goals diverge. One can be achieved only at the expense of the other. This is why so many people feel like they are running in place. Their savings grow, but their lives become more expensive. Their account balances increase, but their options shrink. The measuring stick is broken. The first adjustment, then, is conceptual. Cash is no longer a store value. It is a utility. It is inventory for transactions. It buys time, flexibility, and optionality in the short term. That is all. Expecting it to do more is like expecting ice to survive in the sun because it always used to. This does not mean cash is useless. It means it has a narrow role. Liquidity matters. Emergencies happen. Volatility is real, but the mistake is turning liquidity into a long-term strategy. In a negative real rate environment, excess cash is not conservative. It is exposed. Once that boundary is clear, the questions shift from how much should I save to where can purchasing power hide when money itself is melting. Historically, the answer has always been the same, even though the forms change. Wealth survives inflation by attaching itself to things that do not inflate away easily. Real assets, productive capacity, and enforceable claims on future output. Real assets come first. Land, energy, commodities, infrastructure, housing things that cannot be printed and are required regardless of monetary regime. Their prices fluctuate, sometimes violently, but over long periods they reflect scarcity and demand rather than policy convenience. This is why inflationary eras almost always coincide with rising asset prices. It is not speculation. It is repricing. Next are claims on productivity. Businesses that generate cash flow, pricing power, and real output tend to adapt better than static savings. Ownership, whether direct or indirect, links wealth to economic activity rather than currency. This is uncomfortable because it introduces risk, but risk is unavoidable once safety itself becomes a guaranteed loss. The third category is mechanisms designed specifically to adjust for inflation. These vary by country and era, and none are perfect. Some lag, some are manipulated, some fail in crises, but the intent matters. Anything that acknowledges inflation explicitly is at least trying to preserve purchasing power rather than pretending it does not exist. Notice what is missing from this list. Promises of stability without volatility. Those only work when the issuer is willing to absorb inflation on your behalf. In a debt-saturated system, that willingness disappears. This reframing explains why generations experience money so differently. Older cohorts lived through periods where saving and investing were aligned. Younger cohorts inherit a world where safety and growth are in conflict. Advice does not transfer cleanly across regimes. The rules that rewarded patience now punish it. The behaviors that once built security now delay adaptation. None of this means everyone should speculate, gamble, or chase returns blindly. That would simply replace one illusion with another. The lesson is subtler and more uncomfortable. There is no longer a neutral position. Doing nothing is doing something. Holding cash is a bet one that inflation will slow, policy will reverse, and real rates will turn positive for long enough to matter. History suggests this is unlikely. The system does not need you to be wealthy. It needs you to be functional, liquid enough to consume, indebted enough to comply, cautious enough to absorb shocks quietly. Saving, as traditionally defined, fits that need perfectly. It stabilizes behavior while transferring costs invisibly. Understanding this does not make the game fair, but it does make it visible. Wealth preservation in the modern era is not about finding perfect assets or predicting markets. It is about aligning with reality instead of nostalgia. It means measuring success in purchasing power, not balances. It means accepting volatility as the price of survival rather than mistaking stillness for safety. And it means recognizing that what feels prudent may be structurally punished. Previous generations were rewarded for delaying gratification. This generation is penalized for delaying adaptation. The instinct to save is not wrong. It is simply misapplied in a system that no longer honors it. Saving money did not become a losing strategy by accident. It became one because the system evolved to survive on erosion rather than restraint. Once you see that, the anxiety many people feel around money stops being personal. It becomes logical. And logic, unlike currency, does not inflate away.